Hi guys. Um, Important video markets are really tough. I'm also sitting on big losses, minus 90%. Um, and also I'm leveraged. I have an exposure about 75% crypto, about 60% growth stocks, and also some short on commodities. So I'm sweating in this market. I don't want to lose again 90%. So I have this fear that I will be wiped out, I will lose everything. Everybody's recommending me to take the leverage off. And that leverage is, well, not smart. And I understand these critiques, and they are fair. Um, but selling today is not wise. Market has corrected. It is a seller's market. It's not a buyer's market. And so when you sell in such a situation, you're not helping the market at all. Right now, there is no need for more sellers. There is a need for buyers. The masses, they are want to sell. They are selling. There is lots of selling pressure. And as you know, the amount of sellers and buyers is always the same. Or let us say the amount of sales and buys is the same. But in order to get a sale done, prices are pushed down a lot because there are many people that want to sell. So what we need right now is buyers to increase the buying pressure so that prices can go up for where it is important to go up, but inversely can go down where it is important for them to go down. But I think the biggest problem in this market is to judge whether, and I see the biggest mistake there, whether stocks are relatively expensive or not. And of course, cryptos relate to that because if the stock market does well, crypto will likely do well too. If the stock market does poorly, crypto will likely do poorly too. So, and what you see often is that people show these kind of charts here where they they show long-term charts of the S&P 500, for example. Actually, they don't show the long term. They show starting in 2010 or so, or 2008, at the bottom of the financial crisis. And they show like, oh my God, this went up so much. This is a logarithmic. So basically, it's a fair chart where you see that every doubling is the same kind of rise. And so if you go from 500 to 1000 as a doubling, but from 1000 to 2000 is a doubling too, and it's the same distance. From 2000 to 4000 is the same distance. And so you see that from 2000, stock market did nothing till 2012 here. And then it went from 1500 to 4500. That's a tripling. And so people say, look, this is really extreme compared to previous periods. This is a major bull market. It's time for a serious correction. But there are a few important notes to make here. This is actually starting from the 1990s, but actually the 1980s. You will see that it went up a lot also stocks. But even in the 1990s, it went up a lot. And as you see at the rise, is more steep than it is here. This is the end of a bull market, the end of a 20-year bull market. In 5 years or 6 years, you go from 500 to 1500. That's like a tripling in 6 years. However, here it took 1500 was somewhere here. That's 2010, 11, 12 till 2020, 21. That's 10 years. So it takes 10 years here to triple. Here it takes only 5 years to triple. So, but Also, what's interesting is that, yeah, and you can see this in other information also, that the returns are actually not that impressive. And it's certainly not similar to the end of a bull market from previous decades where returns were a lot higher. And that's not only at the end of this bull market, it's also when you look at the end of the bull market before, which was the 60s, not the 90s, but the 60s, it also had much higher returns. That's one indicator to say that actually returns have not been exceptional. They have actually been typical of the first decade of a bull market, but not the second decade, not the last decade. Huh? Though then returns are higher. Huh? What you also see often, and that's the biggest mistake, is to look at bear markets, and they look at this period from 2000 till 2010, where you had two big crashes, the dot-com crash and the financial crisis crash in 2000, 2002, and 2008 till 2009, and you see no returns whatsoever for 10 years for the stock market, and they look at the recent correction, and actually they do that in every correction. It also happened in the Corona crash, that people will look at these drops and they'll say, look, that's actually not very steep. Look at, if you compare it to financial crisis 2008 or dot-com crashes, we can go a lot deeper. And that's accurate if you compare with these periods. But should you? For that, you need to judge whether it's time for the stock market to start a 10-year bear market. And that, I believe, is clearly not the case, because in history there never been a bull market that only lasted 10 years. That would mean that this bull market that only lasted 10 years, that's the end of it. Now it's time for another bear market, but that didn't happen in the past. For that, we go to historical returns, at least the past 100 years. Like before that, I don't have the analysis neither. Huh? So if you have it, please share with me. But this is the most I have. When it comes to cycles, it's um, starting in the well, these are 10-year returns, and they start in 1930, 37. So basically, it's data starting in 1930, huh? And so that's 90 years of returns, and there you see that the bull market lasts. So we have this period of stocks here. That's the blue line. Huh? These are the average 10-year returns. Huh? And what you see that at the bear market, at the end of the bear market here in 2008, returns have been terrible. Huh? From average returns of dropping basically already for 20 years, from a peak in 1990, that's the middle of the bull market, to 20 years later, you go from average returns, and that is after inflation, from 13% to minus 4%. From 2010, you have the start of a bull market here, and you go up in average returns. But here also, you went up in average returns from 1974 to a peak in 1989. And so this is a 15-year bull market. Huh? That average returns were very high. This is a bit lagging indicator because it's the average of the past 10 years that we're looking at. We're not looking at the yearly returns, but you can see that it takes 15 years of rising returns. Here it takes from 1938 till the peak in 1958, 20 years. 20 years of rising returns, 15 years of rising returns, and this is only 2008 till 2022. Well, that's 14 years of rising returns. Yeah, here it was only like 74 till 89. That's actually that's 15 years. Huh? And then we have here 2008. Well, rising returns are actually till 2021, not 2022. And 2021, 2008, those are 13 years. Huh? So yeah, actually, from that perspective, you could say like maybe it will be as short as we've seen here, rising returns, and then it's only another 2 years. Mm, But looking at previous cycles, you should take the averages. The average is here 20 years, 15 years. The average is 18 years, and we're only at 13 here or 12 of rising returns. So from that perspective, there is still no room left for returns to go up, average yearly returns. Um, so that's the time. The the actual returns are also very important. Like, are we at the peak? Did we reach a peak of a bull market as we saw in previous times? Well, average returns after inflation were 10% plus. Here we had actually 1958 was actually 15% after inflation, and here inflation I'm counting 5% per year every year, and here we have 13%. So that's 15% and 13% at the peak of the bull market, and here we have actually only a peak of 7%. It's half of the previous bull market. So that's a much stronger indicator that no, returns have not been as in previous bull markets, for not at all, far from it. And that's the best, I think, strongest evidence that it's unlikely that this bull market is over in stocks. Um, and that exuberance is not has not been there at all compared to previous periods. Um, because that's often what also bears say these days. Like, didn't you see the exuberance last year in 2021? Look how much growth stocks went up compared to their sales, compared to their PE ratios. It was absolutely insane. Is their claim. Um, and they also often use crypto as an illustration that NFTs, for example, it's ridiculous that people pay millions of dollars for a stupid JPEG, of which you have millions or thousands of different stupid monkeys selling each for lots of money. Um, okay, there is that's certainly been the case that lots of um, crap has been pumped and valued too high. Agreed with that, but you ain't seen nothing yet. If you look at the 90s, what people were pumping was not was just stories. They didn't even get a JPEG. It was just a story of a .com company that would conquer the world, and there was nothing else than a story, and there was maybe a registered domain with a front page, and that was pumped into the sky. Um, and of course, you have to cannot compare art with businesses. Art is a difficult industry. Who understands art? Um, but businesses is much easier to understand. And if you look at the business that were pumped into the stratosphere recently, well, actually, these are all very solid companies, with the exception of a few that were scams and okay, some of them were ridiculous in the EV market. Even companies that were going broke, like GameStop or these cinema chains. Okay, the cinema chain justified like they will recover, but something like GameStop not. But yet it was still pumped a lot into high valuations. Fraud has been there, and certainly also in crypto, but it can get a lot worse than that. Overall, the market actually, I would say the crypto market as well as the stock market has lots of value. If you look at all these growth companies, for example, in ARK, invest funds, ETF funds. These are strong stories, strong growth stories, with, with a strong story of rising revenue, strong rising revenue growth. Huh? And so that was not the case at all during the peak of the dot-com bubble. So So if you ask me, like especially considering the sentiment so bearish today, if you look back in the past, in previous bull markets, and we were at similar average returns, what was happening after that? And that is actually quite shocking, and that shows you that the risk is actually not downwards, but upwards. So we have now an average return of 9% per year the past 10 years, and before inflation. Let's look at the previous bull markets where we have a 9% average return and what happened after. So here that was in 1983. We have a 9% return. A bunch of good years, only one bad year. You could say here, like, it's the end of the 70s, early 80s. You could say, like, oh, wow, you look at the market, look at the stock market. Such returns. Such an amazing year. You would become bearish here. Okay, you had only one negative year. But okay, average returns are like 9% here. But they are 9% because the very bad years of 73 and 74 is still included in the past 10 years. Because if you look at the past 8 years, they've been a lot better. But the past 10 years, not, because you have still these two bad years included. Is the same true this time? Let's see. Well, they are not especially very bad years included because it starts to count from 2012, the past 10 years. But yeah, you do have like actually 3 negative years, and that also counts to a low average. But what happened after? Well, average returns go up a lot the past 10 years to 12%, 14% because the bad years are dropping off. But also, new years are coming in that are tremendously good. We have a top year of 50% in 85. The year after, another top year of 44%. And that's how you get like very high average returns of the past year of like 17%, goes up to even 19% at the end of the 80s. That's an absolute peak. But there's a big difference between average return of 19% and average returns of 9%. And that's what I've always also myself really see here. And actually, there are no very bad years that you can chop off the past 10 years here. So what should happen for these average returns to be pulled up? Well, some very, very good years need to be put down in the next few years to pull up that average return. And that's likely what's going to happen. And also, I need to say something about inflation. It's very important because I don't see this analysis anywhere else. I think that really makes my work stand out. But inflation, I calculate, is not based on measuring how much certain products or certain services or certain assets go up in price, and then like deciding how much will you let each product count into the metric. That's the CPI. Very easy to manipulate. No, the way I calculate inflation is how much money do they print? Well, because that's where the inflation is coming from, and that's what will cause inflation. That is actually the definition of inflation: is how much do you inflate the money supply, and then you can deduct economic growth, and that's what you will get. If you inflate with 10% the money supply per year, actually the inflation is actually how much they inflate the money supply per year is I'm deducting 3% for economic growth, but actually economic growth was higher earlier on. So I describe here, this is a public sheet also, that I'm deducting 3% for economic growth, but before 1970, I'm deducting 4% for economic growth from the amount of money printed. And before 1940, I deduct 5% for economic growth. I had to do this because otherwise, actually, inflation numbers that I got via this technique did not make sense. But when I did this adjustment, they do make lots of sense. Because then this is the only thing that I changed to the publicly published balance sheet of the Federal Reserve that expands every year, and that shows clearly how much extra money is being printed. And if I do that, you see here the balance sheet. That's what I used. You can verify that is indeed exactly the balance sheet going back to when I started here in 1915. That's actually when the Federal Reserve was created. That I have the balance sheet going back that much. And here you can see that if you deduct this for economic growth in the beginning 5%, 4%, 3% today, then on average, the balance sheet expands by 5%, 4.7%. And that is what I also take as what I deduct here everywhere from the asset returns, from the asset prices to get to what is the real return after inflation. So, and that gives a chart that you have not seen anywhere else. And that's the chart here where you see stock returns as well as gold returns as well as cash returns after real inflation. And then you can see that, my God, it's not a chart that looks like this or this. You always see these kind of charts. Stocks only go up, it seems. And even during depression, they just go sideways. But that becomes very different when you deduct real inflation. Then you get this. Stocks actually go up, but can also go down, up, down, up. And after real inflation, there are periods where for 10 years you have negative returns with stocks after real inflation. For example, where it looks on this chart that you make zero return because you have still the same from 2000. In 2006, you have the same. In 2012, you have the same. You could say that I have zero returns, but you're not deducting here inflation. If you deduct real inflation, then you will see that, well, actually in 2008, for the past 10 years, you have a negative return of 4% per year. You lost 4% per year. And also, what I have included here are the dividends, which they also forget to include in many of these charts. Very important. But even including dividends, you still have a net loss of 4% per year. Okay, that was the worst year for stocks. That's very rare. But actually, it's not that rare. It happened here also in 1938. It was even worse. It was 5% negative return, 6% negative return for the past 10 years. That was the Great Depression. Negative returns happened again in the 70s, and it happened again now in 2008, 9. So, but the point that's being made is that, there has been massive amounts of money printed during the Corona crisis, and unprecedented. That word, unprecedented, always needs to be dropped in, but it's not unprecedented. It's happened again and again in history. The amount of money printed by the Federal Reserve for the US dollar currency was 75% in 2020 and another 15% in 2021. So about 100%, about doubling of the money supply happened here also in 2008-9, and it was even worse. They did almost tripling here. And when did it happen again? It happened also in 1917, after the First World War. During the First World War, from 14 till 18, actually it was a lot worse. They quadrupled, five-folded the money supply. But after that, they also destroyed lots of money in circulation. But then they have actually been quite modest since then. In the 30s, for example, they did not print much. And often it's said that that caused the Great Depression because they didn't print enough. But we could say that indeed it's a long time ago that they printed so much. But of course, this was very a bad idea also. But what happened here was that because they printed so much money, they got the boom in the 20s, the roaring 20s of stocks, of everything. And people thought they were going very rich, but there was also a major bust then in the 30s. And that was because, well, you print lots of money here and then you start to destroy money year by year by year. Yeah, there comes a point where there's just was lots of money in circulation and there's a lot less money in circulation. And yeah, that causes prices to first go up a lot and then they go down a lot. Like it's like a drunk at the wheel driving first fully left and fully right. Yeah, that's gonna, of course, cause lots of misallocation of capital and depression. So they after they went like drunks at the wheel, they said, oh, we need to do a little bit more modest, have some discipline and print a little bit less during crises. That's why they didn't print so much during the depression. But then they were blamed of printing too little, which happens today also. Uh, it's unbelievable how quickly people think that the Federal Reserve is at fault for creating the economic crisis. And that works the other way around also. When it goes good, then they get all the credit. But it's not like that. On average, they just print money and steal from people and give it to politicians. And they are actually employed by politicians. And it's a big class of people that produces, well, they are important to keep order in society. That's why we have politicians in a hierarchical structure as humans, but it comes at a price, and they need to keep the price as low as possible. They need to create order and a law and a just society. That's where prosperity can happen. That's where people can procreate. But they also need to keep the price as low as possible. And if they print lots of money, which is never to help the economy, because all that printed money goes to government bonds. Those government bonds is money that goes straight to politicians in their pocket. Of course, with some of the money they give stimulus here, stimulus there, but most of it goes to their friends, or a class, a group in society that gets the benefits that they want vote from at the expense of the others. So it's a tax for most people, and well, the more you tax, the more you take, the less prosperity there is, and the less growth there is for the people on average. So, yeah. Why do I say all this? Because people need to stop looking at the fat as the savior or as the doomslayer because it's not like that. Huh? It's normal that an economy goes through booms and busts, booms and busts. It's very normal, um, even with a hard currency, you would have that. Huh? That's unavoidable. It's psychological, mass behavior. Um, and if there's also a group stealing, if there's a group of parasites in society, huh, that takes a lot from, because they are rulers and they have a high price, they take a lot, they have high taxes, or they print lots of money to put in their pocket. That doesn't change, that just makes overall life worse during booms as well as during busts. So that's the story. Huh? But then to say that asset prices will go up a lot because this Fed printed a lot, um, then you have to look at average amount of money printed, and not just for the 10 years, but for 30 years is what I do here. And if you look at that, well, that's 8% per year. Huh? That's indeed higher than in the past, where, for example, we had a 0% per year in the 1970s. At the end of the 1970s, actually, for 30 years, they had not increased the amount of money in circulation. Huh? On average. Huh? But it can be worse. Here you see that, what is this? Yeah, the past 30 years, we have in 1940s, 13% per year that they've printed. Huh? So now we're at 8%. Huh? So yeah, it's an average. Huh? They can print a lot less. They can also print a lot more if you look at history. If you look at the past 10 years, we're at 9%. Okay, that's well higher than the average of 5%. Huh? So there you could say, yeah, they printed a lot the past 10 years. But then here, the past 10 years, in 2000, it was only 3%. Huh? Now it's 9%. So then it was lower than the average of the past 100 years. So yeah, it's higher now. Um, but you can't really say that it's exceptional. And typical is that, and it's very good actually that if they print a lot, that means that's money stolen from currency holders. If they then destroy money later on and take money out of circulation, that's actually giving back to the currency holders. If they do that, that's a good thing. Huh? And so that's what they've been doing in the past. Huh? Every time they printed a lot, they have also had an expansion of money supply. They also have created a contraction where they took lots of money out of circulation. Huh? And they've done that in 1915, 16, after, in the 20s, contraction, but also they did that in the 50s, a contraction, and they've also done that after the financial crisis of 2008, where they expanded a lot, then they also contracted somewhat, though not much. And I expect them to do another contraction over the next few years, which would be very good for the value of the US dollar. Um, and as I've said so many times, Fed does not set interest rates. That's the market. The market sets interest rate. The Fed needs to follow because it's only a player in the market, a big player, but just a player. And if they don't follow the market interest rates, well, then they can't get money. The Fed funds rate is how much interest they pay for balances that you deposit with the Fed. The Fed is also offering this service as a bank that you can deposit money there and get interest. And if they don't raise the interest, then they won't get any money. They need to follow market rates. And that's what's happening now. My interest rates go up by the Fed. It looks like, oh, they set interest rates for society. That's not the case. They just follow interest rates of society. Huh? So why people look at this as, oh, interest rates will go up, so the economy will contract, and it's the fault of the Fed because they are raising interest rates is wrong logic. interest rates go up because, well, we went down in interest rates here. You can see that beautifully here in this chart. We were also in the 40s at historical low interest rates. Then they went up for 40 years, from the 40s to the 80s, from the 80s to 2020, they went down again, and now they're probably going to go up again. And that's just market booms and bust cycles from interest rates. Or much longer cycles than the stock market. But what you see in the past is that even when you are rising interest rates, that doesn't have any effect on stock market. Stock market has boom, bust, boom during a rising interest rate cycle, and equally bust booms during falling interest rate cycle. So there's no reason to look at this and take that as a guidance of where the stock market will go. So if we're judging where will the stock market go, we should not look at interest rates, should not look at the Fed, we should not look at how much money they print, except if it's exceptional, but it's not. And so what we should look at is how do the boom and bust cycles behave in the past, and therefore what is most likely to be expected in the future. And here we see that boom bust cycles take a lot longer and go a lot higher when it comes to stocks. The inverse is true for commodities. Commodities actually, I've not given the story, but it's inversely correlated. When stocks do a bust, commodities, and this is gold here, but that's just because it's easy to plot. But you could take commodities, but it's much harder if you take an index of commodities. And gold do represent commodities because they are very correlated with each other. They go up together, they go down together. And so what you see is that when stocks go down, gold goes up. When stocks go up, gold goes down. When stocks goes down here, gold goes back up. When stocks go back up, gold goes down. But the bottoms of gold and commodities are a lot deeper than what we've seen up until today. And so likely gold and commodities will continue to have worse and worse returns over the next 5 to 10 years. So that's the historical perspective, and those are the probabilities, and there are good explanations for it, because boom busts create supply, oversupply, and shortages. And actually, it's not the boom bust cycle is not created by. Actually, it's the commodity cycle that creates the boom bust cycle for stocks, because it's the old story of that you even read in the Bible, where you have 7 good years of harvest and then 7 lean years of bad weather and bad harvest. And that's what drives the economy fundamentally. That is, do you have lots of commodities? Is there lots of food, lots of gold? Is there lots of wood? Is there lots of produce? Then life is good. But if there is not lots of that, life is bad. And that's reflected in the economy. And so it's the same today. When commodities are in abundance and they are getting cheaper over time, then life is good and stock markets go up. But inversely, if there is shortage of commodities, then and the prices go up of commodities, then well, life is bad and stock markets do poorly. And that's the cycle that we're seeing still today. And so you have to judge how will commodities do over the next 5 to 10 years to judge also what will happen with the stock market. And for that, you need to study commodities and how is the supply and demand situation there. And the people that invest in commodities have a very different opinion than I have. I have a good friend that actually claims that there is a shortage of commodities today and will continue to be. And though I agree with him partly, such as coal and oil have been neglected and have been suppressed by the political climate to be produced. And then you have all the COVID sanctions and red tape and all the regulations, CO2 regulations and global warming regulations, and that all cause an under investment in the traditional energy sector. I agree with that. And I was wrong to not invest in it 2 years ago when coal, for example, went down a lot. Coal miners and were really depressed because they went down for 10 years, and now they've tenfolded again. But that's just a small part of the commodity sector. Huh? There is next to that, there has been lots of investment in energy, but different forms of energy, such as wind energy and solar energy, that they've taken away from the fossil fuel industry, but then they've given to another energy sector. And of course, they took a big cut for themselves too. But that does count also. And since more and more energy is needed in the form of electricity and not in the form of fossil fuels, that also counts. So I think that I was wrong in the short term when it comes to commodities, because I've been telling the same story already for 2-3 years, but in the meantime commodities went up a lot. So I was wrong, and that's because I didn't count for a rebound. Of course, I did. Like, a rebound is normal, and I did not go short commodities at the bottom. But after gold, for example, went up from 1,000 when it had like a couple of good years in 2020 and had gone up here. Let me look at the prices. At 1,500. Here I became bearish on gold, because I said, like, okay, we saw a bottom of around 1,000 here, 2015. That's normal. But now we saw a a strong rebound to 1,500. That's not tenable because it's in a long-term bear market. It will go down again. But what happened then was that the COVID crisis happened, and it caused people to actually invest in gold due to feelings of fear and uncertainty. And I didn't count for that. And then once that happened, I started shorting gold because I thought this is really out of touch with reality and it's due to COVID. And the moment COVID passes, gold will go down. But what happened then is that, well, COVID passes and they're starting a war in Russia, and yeah, well, it didn't go down. But it also didn't go up. Now, many commodity investors believe that it will go up a lot now, gold and other commodities, but I believe that that's not likely, because it's in a long-term bear market, because all of these commodities have gotten a boom in 2000, from 2000 to 2010, and here gold went up a lot, but also gold production went up a lot. Okay, after inflation, it did not go up as much as in the 70s, but in the 70s it was extremely depressed due to the for 30 years. So I mean, that's why it went so high. But on average, you would see that it's quite similar. It comes down to zero basically. The returns for gold in long term after inflation are zero, because, well, 1 kilogram of gold here, 100 years later, is still a kilogram of gold. It's the same, or 1 ounce. So before inflation, looks like gold has returns, but that's just the US dollar goes down in value because gold stays the same. And this is another piece of evidence that my inflation calculations are correct, up to the decimal here. That actually gold has zero returns after inflation. That's correct. The value of gold in society has also stayed about the same. Actually, gold was much more valued 100 years ago. People were still using gold coins to save money, and some places even to pay. That's not the case anymore today, except for some regions like India, but in the West, it's not the case anymore. So you could say from that perspective, gold has lost its function in society somewhat. So its value should be down, its real purchasing power. And that's accurate also, actually. Though it's always compared to what? Because compared to, yeah, I think overall, actually, gold has kept its purchasing power. But it's just that there are many more rich people today than they were 100 years ago. And so if 100 years ago you had the amount of gold to buy you a couple of beautiful houses, well, today you can still buy a couple of beautiful houses, but you're not the only person in town that has a couple of beautiful houses, or you're not part of the top 10%, because actually many more people have a couple of beautiful houses. And so that's a bit the nuance here, that you're just not as rich anymore because of many more rich people, but it's your best preserver of value that you could have gotten without needing to do any management, because you can put it in the ground and dig it up 100 years later. Of course, you put it in stocks, you put it in real estate, you have a lot more, but you need to manage that, so you can't compare that. So yeah, very interesting long-term perspectives here that I believe are of great value to judge today whether you should be long or short the market, because this is a great guidance to make your decisions on. And I believe that this proves that it is very unlikely that we're in a real bear market. So the final thing to say about this is commodities. Are commodities really in a shortage or not? And for that, I believe the strongest piece of evidence is that at the end of a bear market in commodities, what you see is that the price have become so cheap of commodities that there has been a major consolidation in the industry. For example, in gold, only the biggest gold producers survive, and even they start to cut production at the end of a bear market. We saw that. For that, I made another video. I have to look it up. I will link it also in this below in the description, but it's a very important one, because what you see is at the end of every bear market of gold, that the production stagnates and even goes down for a couple of years. And that's the point where gold has become so cheap that it's not even worth it anymore to produce it, because you make losses digging it up from the ground. Even the biggest, most efficient producers make losses digging it up from the ground and decide to just stop the activity. And the actual production goes down year over year for a couple of years. And that's when you know, then that's when you have the evidence that actually we have finally reached a gold price so low that the production starts to stagnate and collapse. And then you know it's the end of the cycle, because it's impossible to continue like that, because the rise, the demand of gold and all commodities goes up over time as the population goes up over time, and so there is just going to be a shortage of commodities, and it will push up prices again. And it has to be pushed up also because the producers are not producing anymore. The prices do need to go up, otherwise there won't be any production. And this point we have not reached a couple of years ago, 2018, 19, when indeed commodities went down a lot in price, but we didn't reach a low price, low enough for production to stop growing in gold, for example. And all commodities, almost all commodities, prices were not low enough. And that's why I said, no, this is not the end of the bear market. But of course, that doesn't mean we can't get a bounce, and that's what we got. And then the bounce can get worse with just political events happening, such as global pandemics, where At the time, hundreds of years ago, it was the past, huh? Or like killing like 20 or 30% of the population. Yeah, that's gonna, of course, push up commodity prices because people stop producing commodities. But still, people still eat commodities, and so there's a shortage. But actually, in that case, I think gold went also down in value because there were less people that could buy gold. So, but the pandemic, of course, caused us an artificial shortage, and then you have war. Of course, is going to also create a shortage because production is getting destroyed with by violence. Huh? Um, but that's not a structural shortage. A structural shortage is when prices have become so low that production stops because of market forces, huh? And that hasn't happened. So my prediction was that as COVID goes by, production will pick up again of these commodities, and the fear levels will go down, and so you see people will stop pumping up prices out of fear, but at the same time production will go up again, and that will cause production prices to go down again, and that will drive the economy positively and will cause stocks to go up again because we will get again cheap commodities. Now this has not played out clearly. I've been really wrong there. Um, Commodities continue to go up after the COVID crisis because of the war that has now happened. But of course, this is another um, yeah, event that is only temporary, huh? Will go by. And so I believe that the opportunity has increased to short commodities, and I still do it with my own portfolio, and I believe it's the right trade. Also, from a different perspective, you look at what's the job of an investor. The job is not to pump up prices that are already high, which you would be doing if you invest in commodities now, or to sell something that is already low, which would be the case if you sell cryptocurrencies or you sell growth stocks now, while you're dumping the prices even lower of something that will be in demand in the future, and of something that needs to be, from which we need more, not less. Huh? And inversely, yeah. So I believe that, yeah, the right moves are to short commodities here, and it's too long growth stocks, is too long emerging markets, and is too long cryptocurrencies. Huh? And when it comes to bond price and interest rates, while the right move is to short in the long term bonds because interest rates will go up, and to short real estate because interest rates will go up, having a negative effect on the mortgages that people can afford, and therefore the money they can put into real estate. So that's my long-term perspective, and yeah, that's what I think was important to share. I hope you enjoyed the video. Thanks you so much for watching, and wish you all lots of courage in this difficult market. Bye. Check my Twitter also. I have made many tweets over the last week illustrating my opinion on the markets with lots of statistics shared by other people. So check it out.